Palo Alto for January 6, 2026. Would the clerk please call the roll?
Councilmember Lithcott-Hames.
Here.
Councilmember Rechtel.
Here.
Councilmember Burt.
Here.
All present.
All right, before proceeding to our one agenda item, we want to give members of the public an opportunity to speak on any item that is within the purview of this committee, but is not otherwise on the agenda. Do we have any speakers?
We do not have any requests to speak.
All right, well, we'll move on to our one item tonight, which is a recommendation from staff that the Finance Committee recommend to the City Council adoption of revisions to the city's investment policy. Welcome. Who kicks it off?
I'll kick it off within 30 seconds and then hand it over to staff. Good evening, Chair, Finance Committee members, Lauren Live, Chief Financial Officer. Happy New Year's and thank you for having this meeting early on. We're excited to bring this item back to you. As you may recall, we had brought on Chandler later in 2025. And as a part of that conversation was to bring this policy back. And given that we had such a robust conversation with you, we thought we'd continue that momentum with the Finance Committee. So we're bringing before you the finance investment policy, and Christine, Chandler, and Jesse have done a tremendous job in doing a thorough review, and they're excited to summarize the recommendation, and I'm sure we'll have questions to follow or during the presentation as well. Thank you.
Thank you, Director Lai. The city's investment policy is required by code and the policy itself to be reviewed annually by the City Council, and this committee precedes that. And as Director Lai noted, this year we worked in collaboration with Chandler Asset Management to ensure that we're staying current with laws, market trends, and best practices. So this comprehensive review focused on council priorities, safety, liquidity, and return. And these proposed changes support those objectives and aligns the policy with resources available to manage the portfolio going forward. We're joined with Jesse Deschamps, our Treasury Senior Management Analyst, and Carlos Oblitas from Chandler Asset Management to present the revised policy and address any questions you might have. So next slide, please. Our review focused on these key areas with these goals in mind, which is to enhance diversification and return potential, to mitigate risk, and also look at and revise credit quality limits and concentration of investments. And then we also wanted to strengthen and protections for the city by adding language to the list of prohibited investments. There's also some updates that were done to the California Code last year that are included in this policy. And also, we just wanted to have a thorough read through to improve readability and clearly define our investment parameters. And then next slide. And we categorized these changes into 3 buckets: policy, philosophy and governance, readability, and technical updates. So under policy, philosophy, and governance, we wanted to shift from a hold to maturity philosophy and a transactional focus to more active management, where we defined the city's minimum liquidity, i.e. the cash on hand we need to conduct operations versus how much we put away and invest in the portfolio. So we've established that. We also established governance through clarifying management directives with Chandler that support all of these goals: safety, liquidity, and return. And we also, with this hold to maturity concept, by removing that, we're allowing tactical sales before maturity so that we're able to flex with the changing market, i.e. if a purchase of investment was done in a very low interest rate market and an opportunity comes where we could invest in higher return and we're not at a loss, we can do that. In addition to that,
if we're not at a loss,
if we're not at a net loss, we can take a loss. I apologize for that. We can take, got it. We can take a loss up front. when we can realize a greater gain for the city through the reinvestment of a higher yielding security, when that action nets us a higher return while at the same time repositioning the portfolio to our duration target, rotating sectors in which we think are going to be in favor, and of course, as always, trying to improve liquidity and the credit quality, taking that upfront loss is definitely desirable.
But under what situations can't we take a loss? So if we bought a bond and now it's underwater, below par. If we sell it, we're not allowed to sell it at that point?
No, you are allowed to sell it, and your policy has been written to allow for those situations. So if generally we try to meet those 4 bullet points that I just listed, when we take a sale before maturity, if a loss is involved, there may be losses, there may be gains. When we're taking losses, we're trying to basically move the portfolio forward. We may be eating something up front because we know that we're going to exchange it for something else. So when can we not take a loss? Well, if those 4 criteria are not being met, generally we try to avoid it. But from a governance perspective, the policy does not restrict you to not taking losses for certain circumstances like that.
Okay. Gotcha. Thank you.
Under policy, philosophy, and governance, we're also shifting from reporting out on a par value basis to a market value basis. And we feel this gives readers a more real-time view of the portfolio's worth and performance. So this is super important when making investment decisions, in our opinion. Under readability, you'll see that we've clarified language related to prohibited investments, how trades and relationships with financial institutions are governed, and also align the policy with code to enhance diversification and our return potential. And then we've also done a detailed review of the policy to, as I mentioned earlier, improve the readability. Under technical updates, we changed concentration and credit quality limits for certain authorized investments. And over the next 3 slides, you'll see how we've outlined, for example, we went from 30%, of total portfolio to 40% for some of them, or some of them we've even lowered because we wanted more flexibility in other categories, or our strategic goal is to change up the mix of investments. As far as credit quality limits are concerned, previously us ASD in the city didn't have resources to continually monitor and evaluate credits. And now we're able to leverage Chandler's credit research team to help identify stable and improving credits, and also ensure that weak or deteriorated credits are avoided and removed from the portfolio. So that added layer of review is definitely helping us take on that additional risk. You'll also see over the next few slides that we've added certain investment types, and I've denoted those as new. We've also increased limits for banker acceptance notes, collateralized bank deposits, negotiable CDs, medium-term notes, and supranational, I always have trouble with that, supranational organizations. And these changes are all in line with the California Government Code. And then finally, under technical updates, we've also expanded the credit rating agencies we're using. Right now, currently, the policy only includes S&P, Moody's, and Fitch. We're changing that to recognize all nationally recognized statistical rating organizations who are registered and regulated by the SEC.
And how many are those?
I think there's 10.
There's like 10, but in reality, we're still going to be looking at the 3. I apologize for that. Thank you. I should probably keep it on and be very quiet. There are like 10, but we really are going to be relying on the top 3. Part of the reason we took that change was because that is the way that the law is written. California Government Code does not refer to any single nationally recognized statistical rating organization, better known as a rating agency. They use the word nationally recognized statistical rating organization, or NRSRO. And we want to have the flexibility of that. As you can imagine, there is merger activity. Businesses change, they merge, they fold. And as a result, just referring to it by a specific name, it's just not optimal anymore. And we opted to follow what the law says. There are other rating agencies that we can look at, especially when a security is rated by one rating agency and we kind of want to get an idea of someone that's not one of the main three. It can help us. But generally speaking, we'll still be looking at the three.
Okay.
It's just a language change primarily.
Okay. But the primary purpose is that the government code pushed you to do that, but you think it's a good idea because it gives you, sometimes if only one of the three has rated something, now if you look at the minor ones, that you now have a second opinion. Is that?
We do, and it's for that. It's precisely that, a second opinion. Generally, we're probably not going to buy it if it's not rated what we wanted by one of the three. But we do use in our internal rating process and in our internal credit analysis process, we do look at the research from other minor houses as well.
Okay, thank you.
Next slide, please. I thought maybe rather than going through red lines, and since the bulk of the changes are in the authorized investment section, maybe we go through the next 3 slides and answer questions as they come up. So I figured maybe we go through this, and then if anyone on the committee has a question, raise it and we'll walk through it. So starting with these 4.
So, no. Sorry. Okay. So when we're saying GSEs, not all of them have the full faith and credit, right? And GSEs generally don't. I guess Fannie and Freddie currently do, but because they're still in receivership, or is that old news?
No, it's not old news, and they do. Even though there's still government involvement in the federal agencies and the government-sponsored enterprises, they still don't have full faith and credit of the United States government. The only government-sponsored enterprise or federal agency that has full faith and credit is Ginnie Mae, Government National Mortgage Association. The rest are full faith and credit of the actual agency. I think what you're alluding to here is that, of course, we're all aware that federal agencies, they have an implied backing from the federal government. There's a strong incentive for the federal government not to allow a federal agency like Fannie Mae or Freddie Mac to go under, because they play such a pivotal part in the greater economy and specifically in the housing markets in the United States. So the only one that has full faith and credit legally is Ginnie Mae, and they generally issue mortgages, but they're long-term mortgages that generally don't really fit with what we're doing here. One of the things that you'll see is that we do plan to buy some GSE mortgages, primarily from Freddie Mac. And they're basically packaged by Freddie Mac, but they have the full backing of the federal agency, which is also a very strong thing to have.
Okay. And what about revenue? Some of the agencies have revenue bonds. Like the post office sells bonds that is based on their revenue. Is that something that we would buy?
Generally, no, because from a GSE standpoint, we want to have GSEs that are large issuers of debt and have large programs where you want to be a minority lender in a very large program. When you start getting to the post office, Small Business Bureau is another one, the bulk just isn't there.
Okay. Part of this is just you want a secondary market that's active.
Precisely. We want to introduce liquidity. We want issues that are widely held.
Okay. And so now originally it was, let's see. So we changed, originally we could have 25% callable, and we're reducing that down to 20. That's our limit. What do you think a target is? Do you think typically you're going to be around 20, or you're going to be lower than that?
Much lower.
Okay.
Much lower, council member. Callable agencies for I'm not sure if everybody's familiar with them. It's a bond where the issuer, and I apologize because I have a cough, but it's a bond where the issuer has a feature built into it where they can call it back before maturity. And the reason they do that is so that they can turn around and reissue it at a lower rate. Think of when you purchase a house and you get a mortgage and rates drop, you want to get a lower rate, so you pay off your mortgage and you get a new mortgage, right, which is a lower rate. It's the exact same thing. So those call features to the investor, to the city, are a risk because effectively you're not getting the money that you thought you would get to maturity. And not only that, when you get your money back, you're going to get it back at a time when rates have fallen, which now forces you to reinvest that money at lower rates. So you lose. It's not a good thing. To try and tease you to buy those, the issuer will pay you a little bit of an extra yield. But that generally, we've observed, does not really compensate you for the additional risk. In fact, when we buy these, we want market forces to be such to where they make them cheap enough and the yield high enough, not because of the issuance or like the rated issuance, but the rate that your effective earnings, because the value on it has dropped. We want it to be such a dynamic to where it really pays off. And those time periods when it makes sense to do that in the last 10 years have been very minimal. Right now, I don't see any reason to buy any callable agencies. You had a 25% limit. We generally write a 20% limit, but I've been doing this for 30 years. In the last 15 years of this, I've probably seen maybe 2 time periods in the markets when it made sense to buy them. And even then, we wouldn't bulk up to the 20% level.
I mean, go ahead. It's like a one-way. Normally, when you have a bond, the price can fluctuate.
Mhm.
If in this case, if the price goes down, you're stuck with that bond. You've lost the money. But if the price goes up, they call it, and there's no upside to a callable bond.
So you've identified in plain terms the exact reason why we really don't. It really has to make sense. We really don't buy them as a rule unless it really makes sense. What we'd like to say is to summarize what you just say, they have none of the upside and all the downside, because when rates rise, values of bonds fall. It's an inverse relationship. So when rates rise, the value of that bond falls, of a callable bond falls even more, because that feature that it might get called really goes away, right? So even so, they're bullets or non-callable federal agencies. When bullets are losing value because rates are rising, the rates are rising, so they lose value. Well, their callable cousins lose even more value. So there's all the downside even more. But when rates fall in the market, it's exactly what you just said. When rates fall in the market, you would expect bonds to go up in value, but that bond is not going to stick around to gain value because it will get called. So you again, none of the upside when there's a rally in the markets, and all the downside. It just doesn't make a lot of sense.
I agree. So I'm glad that you're reducing your exposure.
I just want to make sure I'm understanding the slide correctly. So when it says under the limit and duration, under the GSEs, it says it's new, a limit of 30%. Now, you had just said that we really aren't attracted to these investments because they're callable.
So let's back up for a second. So GSE, federal agencies and GSEs, government-sponsored enterprises, are a sector in the bond markets. Within that sector of the bond markets, there's a subsector which are callable federal agencies and government-sponsored enterprises, or callable agencies. The 20% limit would be applicable only to the federal agency callable securities. The non-agency, California Government Code places no limit on that sector, and you can indeed own up to 100% of the portfolio. This particular limit is in any single issuer, in any single federal agency. So if you have Fannie Mae, Freddie Mac, you have Tennessee Valley Authority, those are some of the government-sponsored enterprises. What we're saying is you have no limits currently. We're saying it's prudent to have a 30% limit per issuer.
And then the next column over on the in the same row, it says from 25 to 20%. Is that saying we're going to have a range? Or is that we're dropping it?
We're dropping it.
Okay. So we might want to just clarify that verbiage a little bit, reducing it from 25.
And it's in the red line of the policy.
Yes.
It is very black and white.
Got it.
Yeah, it's just the presentation.
Got it. I wasn't sure whether that was in fact what was going on there. Okay, thanks.
While we're on this slide, I'm intrigued about the decision to invest in entities that are at a lower bond rating at an A level. And I understand, obviously, the reward apparently outweighs the risk of that. But what is the scope of that change? How many more things do we now have access to because we're going down to the A level?
Councilmember, you bring up a really important question, and it's a question that I was hoping somebody would bring up, because this is probably the most significant change in the policy if you just identified it. Currently, you're able to buy up to AA in the corporate world. If I were to look at a chart of the investment grade world, so this is corporate debt that you're able to buy medium-term notes, the investment grade world. If I were to look at a chart of that universe in the United States, the bottom of the investment grade world is BBB. And you're not even allowed to buy BBB. Okay. And then after EE, I'm going from the lowest to the highest. Okay. After BBB, the next best is single A, followed by AA, followed by AAA. So you're not even able to go down to the bottom of the investment grade world, which the rest of the world does, but that's what code limits you to. But your policy is more restrictive, where you can only go to AA or AAA. You cannot buy single A. The amount of single A name, or let's do it the other way. The amount of AAA names I can probably count in one hand, maybe even less than one hand. The AA world is maybe 10 to 15% of the investment grade world. The single A world, we're now talking 40, 50, 60%. It opens up your universe significantly. It's going to give you access to many, many more names in different subsectors. So not just finance names, but consumer staples, technology, insurance. It opens it up significantly. Now, with that, and I think this is the point you're trying to make as a policymaker, is that this represents additional risk to the portfolio. And you would be absolutely right. You're introducing additional credit risk. So there are various tools that we're using to mitigate that risk. Obviously, you can't make risk go away, but when you're taking on additional risk, you have to mitigate it. So the first and foremost is our credit analysis process. It's a process that we go through where we're not just buying a name because of its credit rating. The credit rating, frankly, is just a filter. It's the initial filter where we can say, okay, well, we know that these qualify. Now that we have a universe that qualifies, let's go through and review them. And then we go through a process where there's AA names that we won't buy because they don't fit our criteria. Okay. And then the second thing that we do is we interlay risk management policies to basically manage the process of these credits. That risk management process includes a list of approved issuers, which is dynamic. So we're not just, the portfolio manager isn't just buying what's out there. That means that all the names have to have been vetted through our credit process and our credit committee and approved by the chief investment officer. And they can only buy from that list. And that list, some names are on hold but do not buy, and some names we just get rid of them. The other, and probably the biggest, the other big one, risk management policy would be that code is silent in the amount of an issuer that you can hold, the percentage that you can hold. There's no limit on the issuer itself, unless you're buying it in conjunction with another type of unsecured debt called commercial paper. But generally, there's no issuer limit. We write a 5% issuer limit into the policies, which is precisely what we've done in your portfolio. You had a limit, but not only do we write them in there, but internally, as a firm, we generally do not expose the portfolio to more than 2% per name. In fact, the portfolio managers start getting really nervous. The chief investment officers start getting really nervous when we're approaching that 2% threshold, because they want to have we want to have a lot of small eggs in one large basket. We don't want to have a few larger eggs. Indeed, what you will see is you're going to see some holdings that make up as much as, especially in the size of your portfolio, as much as 0.1% of the portfolio, 1/5%, 0.5%. You may see some of the stronger credits that might make up 1% or 1.5%. You're going to see very few that make up much more beyond that, and you won't see any beyond 2%. But we write 5% just from a threshold standpoint in the policy.
Thank you very much. That was really informative.
One follow-up question. In the Great Recession, at what point in these different categories were there defaults, or near defaults?
Absolutely. So as you're aware, during the global financial crisis, the government stepped in and took over the government-sponsored enterprises and the federal agencies. And the reason they did that wasn't so much that they were in danger, but it was more that they were packaging mortgages that included subprime. If you remember the subprime crisis, we're all aware of that and remember that. But they never went under. Nothing ever not paid or defaulted. But the government stepped in, and somebody mentioned, I think it might have been you mentioned that the government, or maybe Councilmember Rectal, you mentioned that the government stepped in and bought them, and that's exactly what they did. So there's that. We're not buying mortgages. We will be buying federal agency issued mortgages, but none of them will be subprime. In fact, some of them carry some extraordinary protections for you, which I can get very technical about and talk about. But that's one. I'm just trying to answer your question, and that's one sector. The other sector that had trouble. Are assets that you're not allowed to buy. Some of them are called collateralized debt obligations. These are basically pools of receivables of all types. So it would be like a bucket of debt, including airplane leases, manufactured home leases. I mean, I can go on. So you're not allowed to buy any of those, so you have no exposure there. And then, of course, because this was a hit to the greater economy, you did see some names that experienced some downgrades in the medium-term note sector. And as I recall, the ones that took the biggest hits or the early ones were Washington Mutual, if you remember that name. AIG was a AAA rated name. They got downgraded. I think they ended up at a single A. Lehman Brothers, Bear Stearns. Okay, so those were some of the dangers. But I will tell you, most reputable firms that had a strong credit process weren't invested in most of those names. Lehman Brothers is a perfect example. You could see the tea leaves well before their stock price was dropping quickly. Investors knew. At the firm where I worked at the time, we limited our exposure to just their commercial paper, which is 9 months short-term debt. We weren't buying medium-term notes. So this is why you have mitigating factors that mitigate. You are taking on risk, but you have to be able to mitigate it by risk management, by credit analysis, by fundamental analysis of their financials, their ability to generate revenue, multiple lines of revenue, how they stack up with their peer group. Are they at the top of that peer group or at the bottom of that peer group? It's just, I mean, their ability to generate cash, their holdings. I mean, GE, we weren't buying GE months before they had problems with their turbines, and they were downgraded below that credit quality beneath which you're not allowed to purchase anymore. So it's a process. It's definitely a process. It definitely adds additional credit risk to the portfolio, but we aim to mitigate that through these processes.
How much greater gain do we have from, on average, from like an A to versus a AA or a AAA?
So that's called a credit spread, and so you'll hear me use that term around. It's how much more is that's called the spread between AA and single A. Not a ton. Not a ton. And the reason is because credit spreads have been compressed significantly. It's less about the additional yield, although there will be additional yield picked up, and it may be anywhere from 5 to 15 basis points higher. 15 basis points is 0.15%. 10 basis points is 1/10 of 1%. I don't want to throw jargon. I want to make sure that we're all, please stop me if you have any questions on this. I don't want to throw jargon at you. I want to be plain spoken. But it's that we're looking at additional payoff, but it's also that we're looking at additional diversification. Right now, you are really not able to diversify the medium-term corporate notes in your portfolio because you're limited to just a few names. You really can't do it. We want names in there, as I mentioned, from different subsectors, not just a bank that's issuing, but tech, insurance, manufacturing. You'll recognize a lot of the names in there.
Can you further describe the benefits to the diversification? I get it in principle, but I just want to have a better sense.
Absolutely. Their responses to a movement in the greater economy are less correlated because they come in from different sectors. That's the first and foremost. There's less correlation. The capital markets are the capital markets, and correlations can sometimes they can all correlate, but generally speaking, in a normal market, we're really looking at try to
Who's most exposed to an AI bubble bust?
Who is most exposed to an AI bubble bust?
Yeah.
Well, NVIDIA for starters, because
No, but
they
I mean,
fuel it.
out of any investments that we might be involved.
Well, in our approved list, I don't have our approved list memorized, but I can tell you some of the names. We do buy Meta. We do buy Amazon.com. We don't purchase NVIDIA, but we do purchase Apple and Alphabet, which is Google. So those would be some of the tech names that you have in there. But at the same time, we purchase Prologis. That's a logistics corporation where they move merchandise, and that's AI is not going to do anything to them. It's about trucking and warehouse space. We invest in a REIT where they issue bonds to be able to basically acquire and manage warehouse space. And I'm trying to remember the name. That's an example. We also purchase bonds from U.S. Bank. We also purchase bonds from New York Met. Or New York Life, MetLife, Guardian, Chubb. So some of these are private placements in the private placement market, and they're AAA rated. So this is what we're after. We're after that diversification.
But AI server farms, they're not. It's really transparent who's investing there, and if that's where the bubble may bust or part of it, is that all real transparent?
Well, it's transparent. The fundamentals that drive the value of the bond that we would buy are very transparent. The way that the issuer generates their cash and their ability to pay you back is very transparent. The players involved are very transparent. So even in the private placements that we're able to buy, I can discuss that more in detail. But even with the private with 144 issues, which are limited to a credit or qualified institutional buyers, of which the city is termed as a qualified institutional buyer, even those which publish less information, those are very transparent. Apple issues in that market. Apple's fundamentals. People in Bangladesh are buying Apple. So those are very accessible. The information is accessible, and we have access to it. And not only that, our team, part of our credit process is to meet with the finance teams in these issuers. So we meet with every issuer in our approved list to understand how they think about the markets, how they think about their future prospects, how they explain various aspects of their balance sheet and income statement, and where the company is headed. We sit across tables from them, and that's a fundamental part of our process.
Thank you. So I've advanced to the next slide.
I can go on for hours. I apologize.
We've been asking you questions along the way, but yes.
The next slide, we'll get to more of the credits because it definitely is a sticking point, at least for decreasing those credits. But
I want to answer Pat's question though. If you look at the current, this is as of September, what Palo Alto owns, we have Alphabet, Microsoft, Apple, Johnson & Johnson, and Microsoft, yeah, and then a couple universities, and then Northwestern Mutual Life Insurance. Those are all the corporate bonds.
Yeah, I'm not so concerned about the viability of those companies, but it's all these other folks that are doing massive, real estate investments related to server farms and a lot of that. And I'm just, so much is happening on a massive scale quickly. And I just don't, I wanted to understand, is everybody confident that it's transparent which of these, we say warehouses, but is somebody in that business actually investing in real estate related to server farms, for instance? And, I just wanted to get a better sense of
And I think Pat often reminds us of the many bubbles that we've had over the decades, and he's spotting the next one coming. You know, it might be helpful for us on a more periodic, ongoing basis to just check back in on this issue. We don't want to be caught, you know, in an unfortunate position if and when that happens, and to just know that our partners are aware of our concern about that would be great.
That's helpful to note, and that's something that we will definitely keep in mind. We think a lot about all of this. I'm about to roll off one of our internal committees. I was the co-chair for our multi-asset class committee, which is where we invest in monies that go beyond monies that are governed by California government code. So I'm talking about pension-like investments, Section 115 trust, post-retirement medical, things like that, where we invest in everything. So this is an area where that committee is keenly focused on what our outlook is on the next bubble, on whether AI is going to blow up on us, and not just that, but also geopolitical risk, currency risk, what's happening with oil, things like that, commodities. So that information filters down and is shared at the committee level with all the committees, but it's and also our risk management committee, because we have an actual risk management committee that's built to address things like this. So, but it is helpful to note your specific interest in this field, and we will keep that in mind.
Couple questions on the ratings. So if you are going down to A, do you limit yourself just to short-term notes as opposed to, you know, if you have an intermediate term bond, do you now want AA for that?
No, we are comfortable. If we're going to buy a single A credit, we are putting it on our list of approved issuers because we've done the work on that particular issuer and are comfortable buying it out to the maximum limit of 5 years.
Okay. Oh, maximum for 5 years.
You are not allowed to go beyond 5 years for medium-term corporate notes. The policy does have provisions that allow you to go beyond 5 years, but that by law can only be federal agencies, municipal securities, and treasuries.
Oh,
yeah.
okay.
Yeah,
So corporates can only be 5
you
years.
can only go 5 years for corporates, yeah.
Okay. And so if it's a single A and if it gets cut down to triple B, do you sell immediately?
No, because that may not make sense. Sometimes
Okay.
you can see market movements which are immediate. And so first of all, let's talk about it from a legal standpoint, from the compliance with the law standpoint, and then let's talk about it from the economic aspects of it, because that's the one that you worry about the most. From the legal standpoint, California government code only applies at time of purchase. So if a security is downgraded beneath that credit quality that makes it eligible for purchase, you are not required to sell it. California code does not force you to sell anything. It only forces you to apply the precepts of code at time of purchase, and that's straight out of 53601, California Government Code 53601. So from an economic standpoint, if you have a downgrade that goes beneath it, obviously when there's that downgrade, that bond loses value. What we generally observe, this isn't always the case, but what we generally observe is that there will be an immediate reaction by investors, and it'll be an overreaction. And then as news comes out, they ratchet back that reaction, and those levels tend to come back. So we don't always advise to say, just get rid of it. What we do is we notify immediately, and we also advise with our plan on what we want to do with that bond, and we want to make sure that staff is comfortable with it. Sometimes the feedback from staff will be, get rid of it. I don't want to have to explain this to the city council. I don't want this in the policy. I don't want a citizen to come back and hit us over the head with it. And we get rid of it. Or sometimes they say, we're going to be okay. If you think that that's the best course of action, sometimes they'll say, what triggers do you have to start moving out of it? Or they might say, let's give it a certain amount of time and then get out of it. And it's always a plan and a process. There's no black and white sort of, we just do this, because that doesn't always make sense. We want to do what makes sense for the city. And that's why we notify immediately. If there's a downgrade beneath single A in any of your issues, the first thing I'm going to be doing is picking up the phone and calling your team, and they're going to know what our plan is. Luckily, that doesn't happen very often, and obviously part of the credit process is to try and avoid that.
But even if there's not a cut, if there's a ratings watch, then do you call, is that the same thing?
No, because the ratings watch is not an actual ratings movement. The actual rating doesn't move, although the ratings watch will factor heavily in our analysis of that issuer. And the credit team may place a hold on it or may start selling it gradually.
Okay, thank you.
Okay.
Should we move on to the next three types of investments? collateralized bank deposits, money market mutual funds, and a new one, shares of beneficial interest issued by a JPA.
Can you talk more about collateralized bank deposits? Is that,
course.
is that like a repo or is it something different?
No, it's even simpler than that. It's your bank account. It's your bank account at the bank. Believe it or not, California government code treats your bank deposit as part of your investment program. They view it, and there are rules around your deposits primarily. And this onus is not on you as the city, but actually on the bank itself. The bank is required to collateralize that bank deposit. Any deposits that you have at the local bank, the bank is required to hold collateral in some form, typically treasuries and agencies at some percentage of the portfolio over collateralized. So we just wanted to make sure that bank deposits are included in your policy because they are part of your investment program. And then we label them collateralized bank deposits because by law they're collateralized. Now, bank deposits do carry, in the United States, carry FDIC insurance up to the first $250,000. If you're using a credit union, and what is it, National NCUA will also carry its version of FDIC, basically. So your CFO finance director as or whoever the treasurer is of the city, you have the ability to waive collateral for that under the law for that portion which is covered by the insurance, but anything beyond that still has to be collateralized. But the law requires the bank to collateralize it. And indeed, banks have to submit to the state controller's office or the state finance office. They have to submit to Sacramento on a weekly basis what collateral they hold for any local government money.
It's not in here, but in the report, you limit the portfolio, the amount of CDs that you'd have on that. And if they're all under FDIC, if you've broken up enough different places as FDIC, why would you limit that?
Because so let's make sure that we talk about the right ones. There are certificates of deposits, which are time deposits. If I go down to the local bank and say, what will you give me for a rate for a CD? And it's illiquid. It's a deposit. It's going to sit there. It's going to earn interest. It'll accrue interest until it matures. Then you get your money back. If you break it early, there's a penalty. You lose your accrual, basically. That's one CD. That's a certificate of deposit. I think you're referring to the negotiable certificates of deposit in your policy, which are a different sector. And it's in essence a CD, the same concept of going to your local bank, but these trade, there's a secondary market for these. But under banking rules, they're still considered a deposit. And those, as you stated correctly, those do carry they're required to be collateralized, or let me back that up. They're not required to be collateralized. They have FDIC insurance for the first $250,000. The problem with those is that $250,000 is a very small, especially for the size of portfolio that you have, is a very small name. And a very small, it's an odd lot, which makes it very illiquid. If you're buying one of those, in essence, you're going to be holding it to maturity, and you're going to have a problem if you lock into something that's 5 years long, and you're buying a $250,000 tranche. You to sell it, to reposition, to get a better yield, whatever you need to do. Maybe you need the money. You're going to take a major haircut in getting out of it, even with that FDIC insurance. It's just very liquid. Sometimes those are called brokered CDs or broker CDs. They're popular. There are services that broker them, that will aggregate them. They'll go to banks all over the country and get basically a CD from them. And there'll be banks that you've never heard of. Fifth Bank of like Wichita Falls, Texas.
Wichita too.
And you've never heard of it, and they don't care because of that insurance. But again, if you needed to sell it, we want liquidity. We want things that if there's an emergency, you can access that cash, and there are robust markets behind it. We don't just want the yield.
Yeah, that makes sense.
And for that reason,
CDs are not liquid.
Yeah.
Okay.
And
Gotcha.
Carlos, you also added, we also added, proposed in this policy that anything above that FDIC insured amount must be rated at A1 or better.
correct.
So if we wanted to go beyond that 250, and you'll see on our last investment transaction report or investment activity report, there's about 7 or 8 pages of CDs. If we wanted to consolidate them into more like single issuers above the 250, we have that flexibility now.
And it might be helpful to note that that A1 that's listed there is a short-term rating.
Mhm.
The language in the policy itself also addresses longer-term CDs. So, because you can buy a negotiable CD out to 5 years as well. Let me back up. You can find CDs that are out to 5 years. You probably won't find anything longer than 5 years. 5 years. Code is actually silent on a maximum maturity for CDs, along with municipal securities, treasuries, and agencies. We talked about that 5-year limit. That's one of the sectors that doesn't have a 5-year limit. But there are longer term CDs, and what we're saying in the policies is that you're buying a long-term rating, and if any amount that's beyond that FDIC insurance amount, it needs to have either a short-term rating for the shorter maturities or a long-term rating for the longer maturities.
Okay.
Mm-hmm.
I want to talk about the single rating agency. The danger is that the issuer goes shopping for rating agencies and finds one that, because they're paying, right? The issuer is paying the rating agency. Is that a concern that we only have one? Would it be safer to have two?
I have 2 responses to that. The first response is that after the global financial crisis, the rating agency world, the NRSROs, took note. They very quickly took note because they were rating a lot of these mortgages, and they got in trouble for it. So that, as a concern for investors, is much less of a concern today than it was back in the day. Okay, so that's an answer for no, we're not concerned.
Did Dodd-Frank address that?
Well, Dodd-Frank really addressed more the personal liability of the officers of a company and how they put their names on the financial statements and how there's penalties if there's missteps and omissions and things like that. So I don't recall that they really did anything for the rating agencies.
Okay.
Not off the top of my head, I might be wrong.
So Sarbanes-Oxley was the one that did the.
So
first
Sarbanes-Oxley did that, but
Dodd-Frank.
Dodd-Frank I don't think touched the rating agencies.
Okay. Anyway.
So the second reason that I would say that we're not as concerned is because most issuers are actually getting 2 ratings. The only sector that really sticks to 1 rating is municipal issuers. Generally, most municipal bonds generally carry 1 rating.
Oh.
Yeah.
Mhm.
If you're buying a corporate rating, generally they'll go to S&P and Moody's or S&P and Fitch or Fitch and Moody's. They usually generally carry both. Now, we did this to mirror the law because the law, California Government Code, only requires 1 NRSRO. You can have split ratings. You can have Goldman Sachs is single A rated by 1 rating, one of the major rating agencies, and the other is a triple B. That's still eligible. Generally, we're not buying that especially for you, when you guys are very sensitive about credit. That's not a name that we're going to put in there.
Could Palo Alto buy Palo Alto munis?
Absolutely.
That would be legal.
Correct. Yeah. You are allowed to buy them. You have to be very careful. It's generally a good idea to work with your municipal advisor. The reason is because that bond can be that action could be considered a pre-refunding, and it may have tax implications. But you can buy it on a secondary market. Absolutely, you have the ability to do that, and and your language addresses that. And I have clients which do that.
Let's see. I don't have anything on this.
Okay.
That was the last of our summary of the authorized investment, so that concludes our presentation.
I do have a bunch of other questions. I don't know if does Julie. Okay. But again, chime in here because it's more of a discussion here. How does our compliance work? We have compliance standards. How often do we determine whether we're in compliance or not?
Prior to us coming on board, I'm not sure. I can't speak to that. But the process, the way that it works today is you have a pre-trade compliance. So the way that it works is, in essence, this policy in its current form without these changes currently has been rewritten into our compliance module as a set of rules. And we use a product called Bloomberg AIM. We do all our trading on the Bloomberg system. So Bloomberg AIM is our compliance module, and the precepts of your policy have been boiled down to rules in Bloomberg AIM, which has been written by our compliance team after reviewing your policy, reviewed by the portfolio manager, and reviewed by me. So we take that, we boil it down in the rules. When the portfolio manager goes to purchase a bond, that module looks at that trade. And if that trade does not meet the requirements of that rule, that trade gets kicked out automatically.
Okay.
If the portfolio manager tries to override that trade, there's a notification to the chief investment officer and the chief compliance officer. So we're not doing that. We're not breaking it. Now that's pre-trade.
Yep.
That's before trade. After a trade, every day there is a review of an electronic review of the portfolio. And then at the end of the month, there's a report that's issued with your statements, your month-end statements, which basically report on what the status of compliance is. So staff already gets that. They get that on a monthly basis. So there's that pre-trade, and then there's that post-trade check, and then there's the monthly reporting. And then on a quarterly basis, when I come down here to update staff on the status of the portfolio, that's part of one of the reports that I go over as well.
Okay. So we only,
The compliance confirmation is also included in the quarterly investment report that's submitted to the council as well.
so you don't have something that runs every night that checks compliance, all these percentages and things like that.
Every day it does,
Okay.
yes, at the end of the day. But more importantly, it's pre-trade. Every single time that there's a trade that has to be done, that's when it runs. So Bloomberg AIM, what Bloomberg AIM does is it spits out something called a VMGR, and I can't remember what the acronym stands for, but basically it's a warning. At the end of the day, it spits something out where the compliance team comes back to us and says, hey, we got a warning here. What's going on? Let's go. So we have to investigate. We have to go back and look at it and determine what was something caught within the rule, what's happened there. So there's a daily compliance pre and post trade every day.
So in the changes, we are changing a lot of things from par value, so a lot of the compliance limits from par value to market value.
Correct.
And which means that the compliance can just on its own, without any trades happening, we can change compliance, become uncompliant. Right?
Yes. But remember that this is a safety liquidity portfolio. The average duration of this portfolio is 2.5 years. So what that means is that it would take a 100 basis point shift, meaning a 1% shift in the capital markets and rates across the board to move this portfolio duration 2.5, to move this portfolio market value 2.5%. That's a dramatic shift. That's an over many months, generally
So
speaking.
it's not going to happen overnight.
Well, the last time it happened was when we had the pandemic and rates went from like 1 to 0.
Yeah.
Right. Which is technically a rally. They went up in value. Okay. So it would be a dramatic thing for this to really for a market value to make you out of compliance. But I want to go back to what I said earlier. Compliance under the law is actually at time of purchase. If the market value changes such that the percentages go beyond what's currently allowed by the policy, that is not a compliance
You're not forced to
violation.
sell at all.
Right. But, and this is a debate internally, that does get flagged internally, and the compliance team comes after us and says, oh, what's going on here? And then we have to no, it complied at time of purchase. What they might do if it flows through the statement is they might flag it and then put a note next to it that says complied at time of purchase, which is what you need.
How hard is it these days to find the market value for some of these bonds?
Not hard at all.
For treasuries, it's trivial, but if you're buying corporates or munis, is there automatic quoting, or do you still have to call up a broker and ask for a quote?
No. So there's no more phone calls. Everything's done electronically.
Okay.
That's what it was like when I started like 30 years ago.
Okay.
So there's no more pick up the phone and talk to the broker. We see the brokerage inventory, but as you're aware, so bonds don't trade like stocks where where the stock market, you see a ticker run across the bottom of the TV screen, and that's the price for everybody because there's a supply and demand that a market maker is determining at a central exchange, and that's the price for everybody. Bonds don't work that way. It's like buying bottles of milk. I can go to 7-Eleven, I can go to Safeway, or I can go to Costco. I'm going to get 3 different prices because of the bulk. Right. So that's one of the things that we try and do is we're going to the Costcos of the world. So the market value of a security of the securities that you're purchasing in the bond markets, it's whatever someone's willing to sell it for. That's the value. However, you need to value it in your portfolio. So what most institutions do is they take a third-party pricing source, and so we get we get a vendor that provides us a pricing source. U.S. Bank does the same thing. That's what you were getting before we came. So our market values may differ from what U.S. Bank has, but it'll be very, very minimal. So for those of you that are accounting wonks, GASB 72, the Governmental Accounting Standards Board pronouncement number 72, requires your staff at fiscal year end when they issue the financial statements in the audit, it requires them to classify the market values observed for every asset in your portfolio. And there's 3 categories, those that are immediately observable, those that are observable based on similar securities, and those that are not observable. And that's one of the risk disclosures that you have to put in your financial notes.
Okay, so the 2 downsides of switching from par value to market value is you have to calculate the market value all the time, but it sounds like that's not an issue. And you also can go out of compliance without doing any trades. Just your portfolio sitting there can by its own go out of compliance, but both those are not big deals.
They're not big deals, and it's also rare. That doesn't happen every day.
Okay. And so we just changed from par to market, we think it's a better representation.
It's a better representation of the true economic position that you have. You can think of the pool. There was a pool in Florida that had a run on the pool back during the global financial crisis. I'm trying to remember the name. It was a pool that had a run. Well, if you looked at your positions, they were posting positions not on par value, but on book value, which is amortized cost, okay? That doesn't really move except for the amortization of premiums and discounts. Now I'm getting into the accounting, I apologize. But basically, it doesn't really move, but it doesn't reflect the true value of the assets. Well, they were buying structured investment vehicles and they were buying collateralized debt obligations, and they tanked. They rode that all the way down. And if you looked at the book value, it was here, and the market value, it was down here. It's not a true representation of what the value of the portfolio is. When you're looking at par value, it's the same story. It's not a true representation because the market may treat it differently. We want to be able to make decisions based on what the true economic value of the portfolio is, and you can't do that by focusing on par value. You have to look at market.
Okay, that's good. Let's see. Maybe I should pull up the red lines here. And so let's go to packet page 13. And so I like the changes you made. Overall, I think that you did a good job on
Thank you.
the staff and
That staff had a big hand in it as well.
Yeah. And so I like the changes you made. I like the change on, let's see, we're on 13, changing from yield to return. I think that's a good change.
Can you actually help me understand? As a layperson, I feel I use those terms rather interchangeably, and clearly there's a distinction that's important.
Council member, you're not the only one that does that. 99% of the world does it exactly the way that you just described it. Yield is a very specific term. It refers to your income as a percentage of what you actually paid for the security on an annualized basis. And it's a very specific term. Yield, when I look at, for example, the yield and maturity of the portfolio, it's based on the income streams that I have in this portfolio on a percentage basis, on an annualized basis. What should I be earning into the future? And that's a very specific term. If any of you went to business school or have any sort of business exposure, a yield is the same as an IRR, an internal rate of return, if you're familiar with that term. Okay, so people in finance circles would understand that, or if you're an MBA or something like that, it's an IRR at the end of the day. A return is a completely different understanding. A return is I started at point A, I ended at point B. What did I add to this portfolio during that time period? How much have I grown this portfolio by for a given activity for a given period of time? Now, ultimately, your income, your return, how did I grow this portfolio, comes from two sources. Interest income, which is determined by the yields that you pick up. Okay, so the yield is interrelated. Interest income, which comes from the yields that you pick up, and also the change in fair value of the portfolio, whether it is realized by a sale before maturity or not. Even if it changes on paper, we're going to record it and report it to staff and report it to you. That's called a total return, by the way. But basically, those two factors are what drive that return. California Government Code, when it states your objectives, and it does that in 53-600 point, I can't remember the exact subsection, but basically, California Government Code states your objectives in order. They're safety first, followed by liquidity, and the third is not yield, it's return. So we want to mirror what code says because that's more accurate.
Okay, the getting rid of the buying and holding, I think that makes sense. The kind of the philosophy, the general rule is like, well, if you hold a bond to maturity, you don't have any interest rate risk. But if interest rates spike, you've lost money, and the only question is do I sell it right now and lose the money, or do I give up the opportunity cost of higher rates and stay at a lower rate for the rest of the time? So you've lost money either way. So I think what you're doing here makes sense.
I have zero response to what you just said because you just said it perfectly. That's exactly what it is.
One thing, buying and holding does prevent you from, flipping and flopping and overreacting. I mean, that is the good thing about buying and holding is you can't, like when I go down the freeway and I switch lanes and try and go faster and I find out that I'm falling behind the traffic because I'm making bad decisions. Okay, back at page 14, item 1. The maximum maturity is 10 years. 10 years is a pretty long bond.
Sure is.
Do we really will we be buying 10-year bonds?
Not with the current strategy that you have in place. If you remember when we met last, we said that we have a strategy. That strategy is to maintain the bulk of the investments primarily between 1 and 5 years and have an average duration. I use that term again, that duration of 2.5 years. Before we were engaged, your portfolio allowed securities where allowed by code, treasuries, agencies, munis, and I said negotiable CDs, but where allowed by code, your policy allowed for longer investments than 5 years. I have yet to see the city that has a financial operation that can withstand 10-year cash flows. We generally see people that can push money out that far. Two places, water and wastewater districts that have big construction projects and joint powers insurance authorities. So Excel, you're part of Excel. They're exploring that right now. We're talking about that with them right now. They're one of our clients. So if you think of a portfolio between 1 and 10 years, the average duration tends to be about 3.5 years. If you think about it, a workers' comp claim portfolio, the average duration tends to be about 3.5 years. So it's a good asset liability match. Cities, your cash flows don't really allow for that. However, sometimes there is value to be had in buying something just beyond the 5-year range because those issuers in just beyond the 5-year range lose a certain percentage of the market to sell to. So sometimes to be able to attract investors, they have to give you it provides for a little bit of a higher yield. So our strategy is to stay between 1 and 5 years, but every once in a while, we may pick something up in the 5.5 or 5 3/4 or maybe even 6-year range. I doubt that we'd see anything beyond 7 years.
Okay. I mean, a lot of cities limit to 5 years, but
Correct.
It makes sense to give you flexibility if you think there's advantage to that.
Cities of San Mateo just went to that. City of Sunnyvale has done that for probably 20 years. They go when they wrote it down to 7 years is what they did, but they do it and we do it for them. They're our client and they were doing it before they hired us because they recognize that there's a little bit of an opportunity, but we're still talking about the bulk of the investments between 1 and 5 years. And more importantly, that duration will be somewhere around 2.5 years.
And so that's a target duration, but we don't have any compliance requirements on duration.
No. And the reason is because The duration really is determining the strategy. As policymakers, you want to be involved at the policy level to basically meet the goals of the investment program, safeguard the money, make sure that it's there for the objectives that you identify that are the mission of the city. But with the actual strategy, the day-to-day changes of the portfolio is not going to change day to day, but the day-to-day changes of the portfolio may shift. You don't want to wait for a next council meeting or next time you change the policy to address that. You
So
want
add-
staff to control that.
So add to that point, we want to modify the policy, but still retain certain level of flexibility for us to be able to be strategic throughout the year and at any given time on our portfolio. And
Okay.
hence the 10 years as an option on the table. We
Yeah.
don't want to dial it back
Well-
so much that it confines our strategy.
Yeah, if you trust your asset manager, then you want to give them more flexibility, right? So yeah, I'm okay with that. Particularly if you have a portfolio duration target of 2.5, I think having some long-term bonds is acceptable. So number 3, liquid investments. Should we be defining liquid investments?
Before we said liquid investments, it had an actual hard dollar figure. I think it was 50 million. And the reason we collaborated with staff to update that is because that does not reflect the fact that the investment program may grow through returns, through revenue collection, through debt issuance, or it may shrink, either one. And a hard, steady dollar figure is not reflective of that. The reason we went to liquid investments is because generally speaking, the investment world considers liquid investments a year or shorter. And we just figured, as long as we have at least, we're maintaining investments that are a year or shorter generally, that works.
Should we be specifying that in the policy to have a definition of what we consider liquid? Because what one person thinks is liquid investment and another person wouldn't necessarily agree with that. So it's kind of a vague terminology.
Right, and that section was pre-existing. So 1 month's net worth, basically you could say in a year or less. Yeah, you have to think about what you're, you have to do some math to kind of figure that out.
But you both have a duration issue or maturity issue, right? You also have, if it's thinly traded, it may not be liquid also.
So there's always that aspect which would be specific to the investment portfolio, but I want to remind all of us that the policy not only touches on the portfolio that we're managing on your behalf, it would also touch upon those investments that we don't manage on your behalf. Staff directly controls a certain amount of your investments through the use of local agency investment fund, the state pool. It also controls the funds that are flowing through the bank. If you remember, staff was very proactive recently to set up a money market sweep vehicle to earn more yield on the investments that flow through the bank. So that amount most of that is already covered by whatever you have in your liquid investments, which is LAIF and a number of money funds. I don't know if you want to add to that.
I think a part of our transition and working with Chandler too was looking at how much dollar amount we need to keep liquid, whether it's in LAIF or our Fidelity investments to have on hand. So even though that's not defined here and under number 3 as a dollar amount, we're continually monitoring at an operational level how much to maintain in those balances.
If I understand the request, is there a request pertaining to us defining the word liquid investments?
Yeah.
Because our practice, we're very aware of what this represents. It's basically money at the bank and LAIF. So we're not confused as to what liquid investment means. This is not any
Can
type
we
of.
explicitly spell out what our intention is?
What, 1 year or less? I
Yeah,
don't.
No, I think the definition is the vehicle is what we're talking about. So like Lauren said, it's the money that's sitting in our account or in our LAIF account is what the council member is asking for. It's not the term nor the dollar value. It's what is a liquid investment.
So
What's
this-
the
I see,
vehicle?
okay, I understand, thank
Yes.
you.
So
Right.
it'd break it down to probably our banking account and LAIF or something of the like.
If we do that, I would request that we, to that amount, we would also include those investments in the portfolio which are a year or shorter. So it would be bank accounts, money funds, external money funds, LAIF, and investments in the investment portfolio of securities that are 1 year or less. Those would be the four. Thank you for that clarification.
Ponder it and I would just want some more clarity there. I'm not going to micromanage what you put in there, but I think the term liquid investments could mean one thing to one person and something else to someone else.
Sure. So we'll update this with Finance Committee understanding based on this conversation. Because the recommendation out of Finance Committee is to advance this policy to the council.
Sure.
So we'll take this feedback, update this before it goes to council.
Okay.
All right, Chair, Committee, we are on page 15. So how are we doing?
Okay. So on page 15, number 4 there at the top, it says shall report this fact to the city council within a reasonable time frame. And what's the definition of reasonable time frame? Like,
In our quarterly reports here, we've had a couple of incidences, most recently with the LA utilities having a decline. And so,
I mean, that's a pretty big change, isn't it? For the investments that we're having, 95%, isn't that a pretty big move?
We've been reporting that in the quarterly investment activity report. I think after pandemic, there was 8 straight quarters where the value of the portfolio dipped. And I think recently it's finally above that 95%. So when you say
yes, so we do it
reasonable
quarterly.
timeframe.
We do it quarterly. However, I think to your point earlier, we don't want to be reactive to changes, right? Because the market can move a lot. So we have a managed portfolio where things will fluctuate.
I'm not saying that you should address it. I'm saying you should disclose it.
Yes, we disclose it quarterly.
Okay. To me, this is a big deal. Shouldn't it be more frequently than that?
Can you share? I mean, we do know market conditions change the market value. We have a managed portfolio. We report it
It's-
quarterly. So
This is the
how,
ratio. Okay, maybe I'm misunderstanding what it's saying. The ratio of the market rate.
So the difference between book value and market value is the unrealized gain loss of the portfolio. So if that delta is more than 5%, that's what it's saying. That's I'm just trying to put some numbers around it so that we can get maybe that might help define it a little better. Most policies that I see don't have a requirement like this. However, you have had that in there. That's a legacy language, and it's not bad language to have. It's just basically letting the policymakers know that in essence that you're losing value and it's gone beyond the 5% threshold. 5% is kind of tight. Quarterly is reasonable. I haven't, I don't really, I don't usually see, if it's reported anything like this, I don't really see anything beyond quarterly.
Oh, really? Okay.
Yeah.
Maybe I'm misunderstanding the effect of 5%, but I guess it's 5% over the book value. Okay, I guess I don't have a good gut feel of how much market can change from book.
So if the book value, so the book value obviously is shifting every day because of amortization of premiums and discounts. If the market value falls more than 95% of that book value as both shift because the markets are moved by market forces, it would basically say if the book value is your stated position, this is what we're holding them at. What does the market value them? What that says is basically is if there's a drop, if the market value becomes lower than 95% or lower than what we actually say we hold them at, you have to be notified. It's not bad language. Quarterly is not unreasonable. These are not volatile markets like say the stock markets, and it's not private equity where there's no transparency. Just the volatility is very low, and that's why generally if I see something like that, quarterly is typical.
Okay. So can we specify quarterly instead of reasonable time frame there? Okay, and then similarly on the next one down the middle of the page, it says, as soon as possible, percentage limits will be restored.
That one I'm concerned about because
As soon as possible is, within the hour, right? That's about
you're looking at number.
what is now number 5.
Oh.
Okay, so this is no longer referring to the delta or the difference between the book value and the market value, but rather a percentage limitation for a particular category of investment. So these are the concentration limits. This is basically saying you have a 30%
Yeah.
cap under California Government Code for medium-term corporate notes. If we go to 31% because the city withdraws money from the investment portfolio, they spend money, now that makes up a larger percentage of the portfolio. What this language says is that you have to work to bring that back.
Mhm.
You putting a date on it, generally you want to bring it back within the next purchase. What you don't want to do is you don't want to force a purchase to bring it back because number one, it's not a compliance violation nor a violation of the law. And number two, you want to make that trade because it's advantageous to the city rather than because it was an sort of an exogenous or
Yeah.
change in the
But-
percentage.
The phrase as soon as possible can mean a whole bunch of different things. It can mean immediately. It can be whenever convenient, right? And so I think I would want to replace that with some verbiage that actually describes what our intention is.
So council member, I might note that at the end of the policy, there is a section that talks about reporting. And so that we aren't making these individual adjustments, I might recommend that we align it with what those reporting requirements are, so that to the extent we change those reporting requirements, it would trigger throughout the policy. So it makes it a little bit more evergreen as opposed to individual item specific. As an example, on the prior one, we were talking, it's called policy review and reporting on investments. That section identifies that we will report out on compliance with the policy, any of these variations, and a few other things on a quarterly basis based on government code. And so if we can internally keep that so that you don't have one reporting requirement in random lines and then
I mean, my big concern is that this can be interpreted as immediately. And I don't want you to be forced to do an immediate sell, just for like we mentioned before, that you may be overreacting and getting a bad price. And so I really don't like the phrase as soon as possible here. I would like some other verbiage.
as reasonable. What if we switched it to the word reasonable?
Yeah, reasonable.
Even reasonable seems kind of vague.
Yeah.
I mean, I want to give you freedom, but because again, reasonable.
I think reasonable makes sense because we're trying to manage different objectives within this policy. And at the same time, keep it a bit vague so we can, there's flexibility.
Yeah, what this is trying to say is we intend to change this, but not necessarily immediately. And
As soon as reasonably possible, I think is what staff is suggesting.
but even I don't want that to be interpreted as immediately, and as soon as reasonably possible sounds like it's like right as soon as possible.
Well, provided it's reason.
Yeah, and so it's well, and what does reasonable mean?
Gives a little more latitude in judgment.
And it balances your concern.
Can we just say just to strike as soon as possible, just say percentage limitations will be restored as investments mature in each category, or maybe will be restored over time as investments mature in each category.
I think there is a desire to put some urgency into it. That's why there is the phrase as soon as possible. But I think making sure it's reasonable, because we as staff have a duty to make sure we're curing any non-compliance.
Okay.
So,
Okay, so maybe just throw reasonable in there
Yeah.
and then, okay. Okay, okay, so we have a lot of protections about 30% of this or 20% of this, and we're protecting ourselves against a market crash. But, you know, either a rogue trader or an employee mistake is a pretty common way that people get in trouble. You know, like the San Diego when they went, Orange County when they went bankrupt. That was due to a rogue trader who was making some bets, right?
It was actually the treasurer tax collector himself who was making those. It
Yeah.
wasn't a road trader. It was the head.
I'm so sorry. Would you turn your microphone on?
Sorry. Yes, it was the treasurer tax collector. It wasn't a road trader. It was the head of the entire. Yeah, exactly.
Okay, and so are there any protections against that? Should we be saying anything? Because there is a section in the back, and I read through it, I didn't quite grasp it. It talks about all the people who can make trades and things like that. But is there ever a case where one person can do a trade without a second set of eyes on that trade?
So right now you're using a registered investment advisor. And we have processes or policies and procedures in place that prevent that. The compliance process, which I described earlier, would be an example of that. The post-trade review, compliance review would be an example of that. And also, as your registered investment advisor, if we violate the policy or make a trade that violated the law, we'd be on the hook for that. We'd have to make you whole. So there's some protections on that already in place.
Okay.
Now, the policy is meant to stand alone whether you're using an investment advisor or not. If you're not using an investment advisor, that's how have you operated all these decades, right? I guess is the question.
Okay. I guess there's enough oversight if you have at Chandler, you have the committees that are looking at the trades and you have the automatic checking. And if someone has a typo and buys 100 times more shares than they expect, that will be flagged then. So
Yes. By the way, I've seen that happen, not at Chandler, but I've seen that at other firms. And that was something that came out of their pocket to make the client whole. That's generally, as a registered investment advisor, that's generally what we sign up for.
okay.
So Councilmember, you'll notice we're taking greater liberties in this policy than we've had previously because we have a registered investment advisor now, and we've changed from doing it in-house to having this more robust organization helping provide this professional service.
Okay. That makes sense. Can you move to packet page 17? So banker acceptance notes. Can you talk about that? What is that?
Yes, that's an obscure part of the money markets. It is in essence a trade instrument. Let's say that you're a retailer of Nintendo boxes and you need to purchase a bunch of Nintendo boxes from Nintendo in Japan. So what you do is you go to your local bank and take out a letter of credit, which is recognized and you can draw on it at a bank in Japan. So basically you can pay off the manufacturer and then come back and bring these goods back here and then sell them. There is a time aspect to that. And because there's a time aspect to that, there's a time value to it. So when there's time value associated with money, that basically you can arbitrage it and
It's
make
like a
money.
bridge loan, basically.
Exactly.
Okay.
It's like a merchant that now if for some reason they falter, generally the not the debtor but the investor can actually take hold of the merchandise. Bankers acceptances, they're allowed by code and they should be in your investment policy, but it's been a long time since I've seen someone buy a banker's acceptance.
Okay. And so should we be having any type of rating requirements or?
Generally, no, because the banks are going to scramble to make these things whole. There's merchandise associated with it. There's some backstops there. Code doesn't require it for that reason.
Okay. Okay, especially if we don't anticipate using it, then it's kind of a moot point. So next one, commercial paper. If you now go to the next page, we have no rating requirements for this commercial paper, do we?
No, you do. Absolutely.
A1 or equivalent. Under A2, A1 or equivalent by at least one NRSO.
Okay, yeah.
Yes, sorry, I missed the R.
So they have to be rated in a rating category of A1 or its equivalent. So if you look at the three main rating agencies, A1 is A1 is the highest rating category of rating. That's from S&P. Moody's is
Okay.
P1 and Fitch is F1.
Okay, I'm not sure how I missed that. Okay, then next page, page 18. So for repos, yeah, I get nervous about repos, but repos can be really boring, but they also can be, if depending on what kind of collateral you have and also who you're buying it from, they can be dangerous. And I'm sure that we're going after the boring ones, but we don't require it here. So, for example, there's no, for counterparty risk, should we enter with only primary dealers who have a certain rating?
Well, the real risk in the repo is that the counterparty doesn't pay you back. And the repo that is described here is tri-party repo. So let me answer that question, and I want to make sure that I state what this is because not everybody's familiar with repurchase agreements, repo. Your real risk is that your counterparty doesn't pay you back, but because it's tri-party repo and it carries collateral, it means that you take a hold of the collateral. So they're collateralized in essence, and they're actually over collateralized under California government code. A repurchase agreement is simply this: a bank needs short-term financing, and they say to you, "Lend me some money. I have this collateral in the form of treasury bonds or agency bonds. I will sell it to you, and then the next day I will buy it back from you at some price, and that price nets you some sort of return above and beyond what you loaned out." Okay, that's why it's called a repurchase agreement, because the issuer is basically effectively buying back that collateral. They're saying, hold these treasuries for me while I borrow your money. You give me money, and then I'm going to pay you back with interest, and I'll take back my securities. I'll buy them back. I'll repurchase them back. The repurchase agreements. Tri-party means simply that they take that collateral, those securities that they sell to you, and they're dropping them into an escrow account. And it's in your name basically. And if they falter, if they don't pay you back, then that collateral is yours. And that collateral is generally valued at more than what you loaned out to them. So because you have collateral, it's not really the case. Generally, repurchase agreements are entered into with a master repurchase. It's listed here, a master repurchase agreement that would be signed with the bank. And generally, these are to set up a repo program is a very complex thing. The reason you want it in there is in the case that you grow big enough to where it makes sense to do that, then you'd have it. Most local governments that use repurchase agreements are going to be the local government investment pools. So the LGIPs, they use them because they're a very important part of the money markets. They're very short term. Generally, most of these mature overnight.
So we have to go through a dealer. We don't do bilateral.
You would have to go directly to a bank and set up your own agreement with them to be able to participate in a program.
Okay. What about the type of collateral? Right now, we want treasuries, but we don't specify it here. Should we say that we only?
As I recall, code actually specifies it for you, and it specifies the percentages.
Okay.
Okay.
Okay. So
But
maybe
we can specify it with the
if
amount.
if code specifies it, it kind of makes sense to have that listed here.
We can do that.
Because right now it looks like you could have any type of collateral as opposed to just treasuries.
So just make a note. We
So,
can add.
Carlos, if you might reference the actual code section as opposed to that in the revision, that would be helpful.
Okay, you got
Thank
it.
you.
That way we keep the policy just at a higher level and we do technical updates every year. It's going to be easier for us to maintain.
Okay.
Okay. And that collateral is held by a third party.
It's held in an escrow account.
Okay. Is that required, or is it, you said generally, or is it required to have a third party?
With the type of repo that you purchase, it's required.
Okay. Okay. Then let's go to packet page 19, which is the JPAs. Okay, and so JPA is basically a pool of governments or whatever that get together and invest stuff. Is that correct?
Correct. The JPA vehicle primarily in the state of California has been used to foster risk pools. You belong to one. Excel, that's a joint powers authority. They basically pool together to manage pooled risk. There are joint powers authorities who sponsor a pool, an investment pool, and that's a very well established and recognized form of an investment pool. Effectively, they become a de facto mutual fund for local governments. Currently in the state of California, there are 4 that exist. We just started the 4th one about 4 months ago. They are in the state of California to be competitive. They have to be AAA rated. Generally, there's no requirement at the code that they be AAA rated, but they all are. They're AAA rated. They're very high credit quality. They function a lot like a 2A7 money market mutual fund. It means that the shares, the value of the shares are pegged to $1. They're most of them, not all of them in California, but most of them follow GASB 79, which is a framework under the Governmental Accounting Standards Board pronouncement, which it's a framework to provide liquidity for their participants. They put percentages around certain maturity ranges to make sure that there's money coming due available all the time. So if people need to withdraw, they can. All the JPAs in the state of California provide same day availability up to a certain cutoff time. They're very liquid investments and very highly rated. And all I would even go as far as saying all the ones in the state of California are very well run.
Okay. And so do we have to specify, because right now this section doesn't talk, it just says JPA. You're saying basically that all GPAs are high rated. We don't have to specify a certain credit rating for that.
No, I think it's best to follow the standards of code. The reason for that is because code has no credit rating requirement. There are some JPAs that will sponsor a longer term pool, and that longer term pool may carry a rating that might be AA, and that's still permitted, and it may be desirable at some point in the future. So we're not recommending that. We're recommending
Okay.
that you mirror what code state, which
Okay.
is what you have here.
And what's the liquidity for this? Is it, we can pull it at any time, or are you locked in?
Depending on the pool, if you're buying longer term pools, some of them may have a 1 or 2 day redemption, but the most popular ones, the ones that people generally use, have a cutoff, same day cutoff. We run one called CalFIT, California Fixed Income Trust, where we currently have an 11 o'clock cutoff, and by the end of this month, it'll be moving to a 12 o'clock cutoff. So you have same day availability for your entire account up to noon, same day.
Okay.
Very liquid.
Okay. The next one is packet page 20 down the bottom, medium-term corporate bonds. I think overall, a basket of corporate bonds, there's a very good risk return for that. Just because if you can diversify these bonds, like you were talking earlier, especially over different industries and stuff like that, the risks kind of cancel out, but yet you have a higher than treasury return. To me, one of the dangers is headline risk. We own Apple, and it now comes out that, Apple has either some corporate problems, but also people get in our shorts because maybe Apple has some factories in Thailand where they're not treating the workers well. And so that headline risk, or we get issues with if a company supports abortion rights, some people love that, some people hate that. And so now we get it from both sides. You can't win. And do we really want to be buying individual corporate bonds when we have this headline risk of their corporate actions now, people pestering us to diversify or to divest from Apple? Right? So would they either a pool? Can we buy ETFs? Is that legal?
It would have to be yes, because an ETF is a mutual fund, and there's a provision for mutual funds in the state of California, but those ETFs would be limited to securities that are allowed by California government code. You'd still hold the bond just in an ETF space. And the problem with that is that you don't have the ability to customize or run any sort of credit analysis on these pools. You get what you get, which is what the manager's buying. And there may be, it's just I'm not sure. I can't speak to whatever credit process there is. I want to
Yeah.
answer your question because it's
Okay.
a really important question. The answer is yes. We do recommend buying individual bonds. You already buy them. You already hold them. This is, as you stated, an ability for you to be able to diversify this portfolio and hopefully add additional return potential. My experience has been, in the time that I've been doing this, my experience has been that generally you see activists generally centered around fossil fuels. That's very common.
Mhm.
And there's a group in the region that'll come down and they'll hit you up on that, guaranteed. Recently, we've seen things related to the war in Gaza, specifically with Caterpillar is a name that we've seen come up. Whether right or wrong, I don't want to speak as to, people have their opinions and they're entitled to those opinions, and that's a legitimate process. But that's where I've seen it. Generally, you may see something with a particular bank that's perceived to be lending to an industry that somebody doesn't like. If I dig enough, you'll
Yep.
find somebody that'll be able to object to anything.
Yep, exactly.
But if
And so, for example, if you had an index fund where you saying, we're not going to pick and choose, the index is just going to smear it across there.
But you still own it. It's still yours. And I've seen activists go after that. And it's much more difficult to diversify the portfolio in an index like that or generate the value that you're getting with these individual investments. We're recommending that you buy them.
Committee members, we also have in the policy a section that speaks to environmental, social, and governance responsibilities. So under that, it's talks about this particular issue. And as we work closely with Chandler, we have some flexibility and judgment as staff as well.
And one of the dangers with, some of these like anti-pollution is that you end up with a very tech heavy, which has been great for the last decade, but also means you're not really diversified as perhaps as you should. And so the danger is that by picking and choosing to fit certain characteristics, you are ending up with almost an accidental portfolio.
We would agree wholeheartedly, council member.
Okay, but anyway, your recommendation is that we still buy individual bonds. You think that's the better route? Okay, I just still.
Yes.
Okay, and so for corporate bonds, do we have any liquidity requirements? Like, I guess these are all pretty big companies. If we're having investment grade, then okay. And finally, the asset-backed packet page 21, asset-backed securities, number 15. Tranches really make me nervous. And in the Great Recession, we had all those mortgages into tranches, and the tranches did not predict how their mortgages are going to behave.
So we're talking about two different sectors here within what's allowed here. So let's back up for a second. If it's a mortgage-backed security that's issued by a federal agency, under California government code, that security is considered a federal agency, not a mortgage-backed security governed by subparagraph O of California Government Code 53601. So this paragraph would not apply to those federal agency mortgages. This paragraph on 15 would apply to private label mortgages, which we don't buy. We only buy federal agency mortgages. And it applies to the asset-backed securities. And the asset-backed securities are similar. We talked about those. If you remember the discussion about the David Bowie bonds.
Yep.
So the asset-backed securities, the tranching is simply creating categories in this pool of receivables. It's a pool of debt, a credit card pool, an auto loan pool. The tranching is in essence creating a category that you're buying into, the rights to that category. The way that the asset backs are structured is you have categories in line with who stands in line for the prepayments. And there are tranches at the bottom of that line which are less liquid, higher risk, and pay you higher yield. There are tranches at the top of that list where they get those prepayments first, are much more liquid, higher FICO scores, and generally pay you a little bit less yield but are tighter. That's part of our analysis, is to understand what tranche we're buying. So there are tranches that we avoid. The term tranching is just simply saying we have categories within this pool that we're buying into, and you're counting on us to buy the most liquid and the strongest credits.
And so like for the auto loans, the tranches would be divided by the credit of the person taking out the loans, or?
And also by who stands in line to receive the prepayments. And those prepayments can cascade. First they hit this
There's a-
one, then after a certain threshold, they
the
hit the
waterfall
next one,
down.
and the next one.
And, okay, and so you obviously are comfortable with the tranches, that you think that you can do enough analysis that there's minimal risk to,
We are, council member.
okay, and we generally take the highest level, or do we think that there's
Everything we
more
buy-
value?
Everything we buy is, and I apologize, I didn't mean to cut you
Oh,
off.
no, no.
So the term senior is specific to the credit rating. Everything we buy is senior. We don't buy subordinated debt.
Okay,
I think what you're saying is you're buying the most liquid tranches, and the answer is yes.
okay. So you're taking the
The
And-
top tier.
okay. Um, and so, so for example, auto loans, if someone defaults, then if we're in the bottom tier, let's see, explain to me how a auto loan top tranche would work.
So in essence,
Is it a waterfall issue, or is it a,
so the top tranche, basically there's two things going on. There are debtors in that pool who are making payments on that. And not only that, but as they make payments, people tend to prepay their debt. That's kind of the way that things work. So when we're buying those tranches, we're looking at those tranches which are first in line to receive those prepayments. Now you mentioned, what if a auto loan defaults? Generally, one of the ways that these structures receive their, there's a AA credit rating, and that's from California code, that the minimum is AA. We're only buying AAA rated issues, AAA rated deals. One of the ways that they achieve that AAA rating is to do over collateralization. So for example, in your tranche, maybe it's X amount, $100 million or so. They're only borrowing on $80 million of it. So there's more debtors in the pool than there's debt outstanding. That's an over collateralization. Another over collateralization is that they might establish lines of credit to be able to cover a certain amount of modeled defaults in there, and that's another form of over collateralization. There's many more, but there's
so
things that we look for them.
okay, and so you look at their model of defaults and you think, is that reasonable? And
Correct.
you only buy it if it's reasonable.
Correct.
Okay. Okay. And so we also in here, the prohibited items, we can't do leverage, which is good. We can't do other exotic investments, derivatives. What about like forward contracts or futures?
So I thought we addressed that one, the speculation, zero
Yeah.
interest.
I mean, the example I would have is if the yield curve is really steep at 3 years, you could buy a 3-year bond and then buy a forward contract to sell it in a year, and we'll just slide down that yield curve.
So there's no language to address that. Where you might get into forward contracts would be when you're buying bond proceeds, and it's usually forward rate agreements. You're basically locking in a rate. You're arbitraging a rate is basically what you're doing, and that's not unreasonable to do with bond proceeds. Some people do that.
And are we allowed to do that?
You are allowed under code, and there's nothing that prohibits you from the language in here. But if that's something that you'd like to prohibit as a function, we would not be buying that. We wouldn't be hedging anything like that. We wouldn't be taking any sort of futures contracts or forward rate agreements or anything like that for the day-to-day management.
Even if it was covered, if you bought a 3-year,
Even if covered, it's
okay,
not. It's
do you
not.
just the risk isn't there worthwhile. The things can go bad. That's the issue.
It's an element. It's a risk element that can throw off our risk management approach. It's just not worth it.
Okay. Another thing that's specified in here is strips. And these aren't conventional treasury strips. This is mortgage strips.
Correct. So you are allowed to buy basically treasury strips, but this is a specific prohibition straight out of California government code. It's where you take the principal only and the interest only. You're not allowed to buy the interest only strips, and that's a prohibition from code
Of mortgage.
of mortgages, specific to mortgages.
And why is that?
Something probably happened a long time ago. It's the same reason you have inverse floaters that are not allowed. It's the reason you're not allowed to buy range notes, and that comes all straight out of California government code.
Okay.
If you're familiar with those. Now we're getting esoteric.
Okay.
It's been a long time since I've seen an interest or people dealing with POs, IOs, principal only, interest only, and if you're doing that, you're throwing out and blowing out all the risk management policies
Yeah.
that we're putting in place here. We're really moving like beyond the pale here.
Okay. So, all right, that's all my questions.
Thank you.
You give it?
I got just as many.
Okay.
No, I don't have it.
I just have a couple in a completely different vein. And I want to thank Keith for his extensive due diligence. Your expertise really shines through, Keith. And Carlos as well. You're so excited about all of this. It makes me excited. And I want to thank staff for their hard work. If we approve this, which one hopes we will, and we move to council, I encourage you to begin with a preamble about why. Because this massive shift to Chandler, which we expect is yielding tremendous benefits, is done for a reason. And it begs the question, why weren't we doing it sooner? What was wrong with the way we were doing it? What kind of risk were we in? You know, there's going to be potentially some people, we can imagine who they might be, members of the community who'll come forward and sort of speak to, the question this begs, why did it take us this long to make this move to Chandler? What other things are we not paying enough attention to? So I just think if you can figure out how to narrate to why this is happening now, why this is the right time, so that we get in front of, the need for this pretty major change in how we are managing our assets. So that's just something I encourage you to do. The staff report also doesn't refer to Chandler formally by its formal name, Chandler Asset Management. It just says the city and Chandler. So I think just updating that and maybe providing a link to Chandler. So if people want to dig in and understand who this organization is and what they're about, again, to facilitate a greater ease in accepting the transition, I think that would be good. And then I know you don't want to make any projections whatsoever, but we are in a budget deficit environment projected out for many years. And we are doing this in part to protect the city and from various risks. And we are doing it in part to increase our return. And so some kind of conservative projection of how this might impact our conversations, our projections around budget deficit. I don't know if I'm asking something that is dangerous to ask, but if it's not dangerous, then I'd like to see us give some kind of hint at what this might do for us, because people are very concerned, and rightly so, about the projected deficits. And if it's going to help.
We had some of that discussion last time we met with you, giving us kind of a ballpark expectation.
Yeah. It was like 2.7 and it was now going to be 4.1 or something. I don't remember. But again, I think to the bigger why, like what are we getting out of this? It might be nice to signal in a conservative way what
Yeah,
we think this might
That's
be.
right. We don't want you to commit to the mean and, be held accountable to that. Yeah. Good. All right. I think we're good then. So, yeah,
I move the staff motion.
which
Second.
is to approve the revisions to the city investment policy incorporated in attachment B.
Second.
Okay, all in favor?
Aye.
Aye.
All right.
That passes unanimously. So thank you for a very thorough and informative presentation and response. And thanks to Councilmember Rectal for having an understanding of a lot of these nuances that the rest of us as lay people generally don't, and that everybody provided answers.
Councilmember Burt,
You're not on.
Well, sorry, and that everybody provided answers that were understandable. So I really appreciate it.
Councilmember, I want to stress two things. Number one, this was a really heavy lift, a collaboration with staff. This is very much their work as well as ours. That's the first thing. And the second thing, I'm just glad I'm not the only person getting in trouble over the microphones.
Yeah. I did that for your benefit.
Councilmember, may I say for the record, we do not have any requests to speak for,
Okay.
for
Oh.
item 1.
Thank you. That too. All right. So just any update on upcoming meetings?
Right now, we're working on the tentative agenda items as we go into council retreat and also priority setting. So we're reviewing it, and typical in the spring, we come back with financial forecasts and utility rates.
And then our mid-year, can you remind us when we and the council are going to, I think we were looking at whether the committee would have ample time to do a review of the mid-year, even if it didn't allow full ability for the staff report to incorporate any feedbacks prior to the packets going out.
Yeah, I think we're still working through that. As you may recall, we have a couple of new budget managers on the team. So we're working through that, having heard the requests at this committee level as well.
Okay, good. And then there was one other open request that we had, which was the number of employed workers and by department that was going to go back to pre-COVID.
2019, just
Yeah.
this afternoon, an ASD staff member and I have reviewed it.
Okay.
And so what I've asked is to listen back to the council meeting from September. In addition, review it one more pass. So our hope is that we can include it as an attachment in this long-range financial forecast that's going to council. It'll be similar to the prior presentation, the attachment where we show the authorized by department and the filled and therefore the vacancy. So it goes from 2019 through 2025. She's working on 2026. If that doesn't happen, because we want to get it in packet, at least you'll have 2029 through 2025. Okay.
When was that?
2020, what did I say?
19.
2019 through 2025
When was the last presentation?
in September.
In September. Okay.
Yeah, we
So
brought that and we had a couple of gap in the data. We have scrubbed 2019 to the best of our knowledge. She's currently working on 2026. And if that doesn't get done, having heard the request tonight, I would just have us include it, recognizing that we wouldn't have 2026 available.
And
Okay.
that would be in the long-range financial forecast going to the council, not this committee, right?
Correct. It'll be an attachment in that report.
And that would be when?
That's going out this week.
Oh.
Packet.
Okay.
Scheduled for January 20th, but the packet will go out this week.
And I would like to acknowledge that we are in a council reorganization moment and committees are going to get shuffled. And I am anticipating that I will not make the cut for finance and I'll be put somewhere else. I don't know, who knows? But should this be my last finance meeting, I want to say how much I have enjoyed it. I did not expect to. I've learned so much. And I really appreciate having had the opportunity to be a part of these conversations on this side of the work of the city. So, and thank you, Chair.
Good. All right. Thanks, everybody.
Thanks so much.